You are listening to the Marc Guzman Podcast Experience.
In prior episodes, we've always analyzed properties that I thought were good. Well, today I thought I'd analyze a property that I thought was not a good investment and the reasons why. And again, this is a 4-unit building in the city of Richmond that we're going to look at today. And
now, real quick, while you're pulling that up, remember, in the city of Richmond, you have to have a business license. You have to register with the fire department for the fire inspection program. There's also a rental residential inspection program. And there's also the newly created from 2016 rent board.
Control.
The rent control board, which is right now $207 per unit. So that's $207 per unit. You've got the residential inspection, which I believe is $150 plus $75 per unit. You've got the fire department, which is $115 a unit, and a business license $238, and that's what you're paying per year.
And in fact, just taking it from my perspective of Richmond, when I first started investing in Richmond like 20 plus years ago in the late 90s, 97, 98, 99, it was a gold mine. It was a great opportunity to be able to invest there. There wasn't rent control, and there was a lot of opportunity. The prices were relatively low, with the rents being at not only being able to support the property's debt with as little as 10% down, but there was a lot of room for growth because the rents were below market. Not to mention at the time, people were very skittish about Richmond, and so it commanded a much higher cap rate. You always hear me talk about cap rate. Again, cap rate is the return you would make if you bought the property all cash. It's one of the few denominators that investors will look at to determine if it's a good property or not. And again, when you're looking at a cap rate, nowadays you're wanting to start at somewhere around 5% cap to maybe 6% cap. The higher the cap, the lower the price, and the higher the cap usually perceives a greater amount of risk, right? So if I'm going to buy and make a return, this is what I would find to be acceptable for my money based upon the risk that I'm taking. So in particular, because of the reasons that Marc had brought up that have now taken place, such as rent control and the rent control board and the various restrictions that are very, very tenant friendly, but not landlord friendly. There's no balance. So it makes it difficult to own real estate in Richmond. There are still reasons you can come into Richmond and make money. There are still value adds there. But in particular, this 4-unit building in Richmond, I thought was a bad investment. So we always talk about what would be a good investment. It's also important to look at what are things you should stay away from. So this 4-unit building in Richmond is asking $799,999, essentially $800,000. It's a configuration of a model that I've personally owned over the years, which is a 4-unit apartment building with 1 3-bedroom, 2-bath, and 3 2-bedroom, 1-bath, and enclosed 1-car garages. So the layout and the aesthetics are great. It's a nice looking building. It's not one of these hodgepodge buildings that wasn't essentially designed to be a 4-unit or an apartment and was kind of carved out throughout the years and turned into an apartment. This was built as an apartment. In fact, it was built in 1984. However, for the various reasons that Marc had brought out, it's no longer a good investment. So let's look at why. First of all, as I mentioned, cap rate's a first denominator that people look at as to why I should invest and whether it's a good investment or not. In essence, or in short, if I'm going to keep my money in the bank earning less than 1%, or put my money in the bank into a mutual fund maybe earning 3 or 4%, then if I'm going to put it into real estate, which is going to be quasi-passive, quasi-active, right, depending upon how you manage your property, then I need to make a higher return than 4 or 5, and I should be somewhere around 5, 5.5, or 6. And I should be in a position through regular rental increases to see my investment grow from a 5.5 to a 6.5, 7.5, 8.5% capitalization rate over the years that I hold it. Now, this building doesn't provide any of those things. Couple things as we go to first slide, you'll see the property's asking $800,000, and I did the typical standard 25% down payment just to see what type of return I would get. And again, when I'm using a down payment and I'm using leverage or debt, I'm going to now look at it from the return on investment or cash on cash return perspective. But just right off the bat, since I'm always talking about cap rate, at $799,000 with its current existing rents, minus a vacancy, minus the utilities, minus the management fee, minus the new taxes and bonds and assessments, minus a new insurance, you have a building that makes a 2.93% cap rate. So less than the 6% that you're, or 5% even, that you want to start out with. And the reason why what that essentially means is that if I bought the building for $800,000, and again, I don't have a debt, I'm just taking in the income, a vacancy factor, all of my expenses, I'm left with essentially $23,462 a year. Over a $800,000 investment is a 2.93% return on my money. That's really, really low, especially for an apartment, right? Now, if you look at the column next to it,
That's assuming no problems.
That's assuming no problems.
You have a tenant that doesn't pay rent, and now you're in a city like Richmond with just cause. And even though you have legal right to evict for non-payment of rent, it can still get very expensive. I mean, an eviction in Richmond will easily cost you $3,000 to $5,000, assuming no jury trial.
In several months.
Yeah, in several months. And jury trial you'll be paying $5,000 per day to an attorney.
Yeah, now keep in mind, in my expense calculations, I do account for the possibility of legal fees, right? Now, here's the big value add for Richmond. Of course, there's the problem of rent control, or the problem of getting here. The property, if it could rent for market, the income would go from $4,397 essentially to $8,112.50, right? If each of the units were rented at at the fair market rent should be. That essentially turns into like a 43% loss to lease, or the difference between what you're actually getting and what you should be getting. If you did get what you should be getting, then suddenly the property should be at a 7.95 cap. Now, in most cases, investors looking at an investment like that, could say, hey, this is not a bad investment because I can get in and I can eventually raise my rents to that amount, even if I just use the standard 8% to 10% a year that you would normally see, where you don't even fall into a rent gouging issue. However, as Marc has pointed out, you got Richmond's rent control, and that with 2.97 or 3% a year.
3.6 this year.
3.6 is the maximum you can raise those rents. So when I applied a 3% increase in rents to the current rent, then what you start to see is you climb from a 2.93 to a 3.11 to a 3.29 to a 3.48. So you're only at a 3.48 cap rate after 4, maybe 5 years. You're still below that 5 cap minimum or 5.5 cap minimum that you want to start with. And then as the market does slow down, you're going to start seeing, in fact, we have been seeing in our prior episode, we talked about properties that started at a 6 cap, right? Because you're beginning to see investors perceive more risk in the market, so they want to have a better return. And so the standard of what investors want to see, or the market cap, begins to climb and the values go down. In this particular property, you start out low, you stay low, and you don't really increase in value. You got that dangling carrot in front of you as far as what it could be worth, and this really high cap rate if you can get all the market rents. It's just that good luck getting there unless the tenants voluntarily move out. Marc could probably speak even more to the legalities of getting them out, or the buyouts that you would have to be able to offer them, because there's standard buyouts now in Richmond, to buy them out of their unit if you want to live in your unit, or you want to be able to make proper renovations and then get market rent for the unit.
Yeah, and now to do the proper renovations and then try to get a higher rent, there is a petition process to go through in Richmond. Excuse me. So there's a petition process to go through at Richmond, but they require a lot of documentation. You're in front of a rent board where they're already not favoring you because the rent board makeup is at least 3 tenants, 2 landlords. So that's the makeup of the rent board. And then they're also behind. My understanding right now is they're behind by 1 year in getting to those petitions. So it's going to be a long process anyway. And basically what it comes down to is, assuming there's no problems at the property, the return on this investment is not ideal. You could literally go to one city over. You could, in fact, we have a client that did that. They bought in San Pablo, bought at like a 4.89 cap, but because of no rent control and because of the type of building, in a few years they're going to be at 6.8, 6.9% cap rate.
Right.
much better investment property than this one. And in fact, that's one of the drawbacks to rent control and just cause ordinances that many cities are looking at considering and putting into place, because in El Cerrito right now is considering a rent control ordinance, is that this rent control restricts the value of many properties that could be in could come back to the city in forms of taxes and many other things.
Well, segueing off what you said, if you value this building based on its actual income, the value of the building should be like $391,000, not $800,000. And in fact, at the $800,000 price point with 25% down, you're actually not only going to have a small 2.93% cap rate to start, you're going to have a negative cash flow of $1,192 negative every month. In fact, you would be at what's called a 0.62 debt service coverage. It's a denominator that lenders will use to determine whether or not it's a sound loan to make, because if you're an investor, are you going to be making money? So what they'll typically want is a 1.2 debt service, with 1.0 being a break even, 1.2 meaning you're making 20% above what your proposed mortgage would be. And in this case, you're making you're making well below your proposed mortgage, and so it's reflected in actual negative cash flow to the tune of $11.92 a month to support the building.
So that's the time that we have for Keeping It Realty. So thank you again for watching. Hopefully we're bringing a lot of value. Please leave comments in the comment section below. Let us know what you like about the show. Let us know what you would like to see on the show. Reach out to us anytime. Our contact information is in the video and in the comments on our pages.
And if you want us to analyze a specific property for the show, or even just take a look at the property for you as a second opinion, feel free to reach out to us at the numbers and the emails that we've provided.
For sure. And big shout out again to East Brother Beer Company for being the show sponsor, providing the beer. And maybe we'll see some of you guys over there at East Brother Beer in Point Richmond. So thanks for watching.
Stay tuned for next time.